Mike Singleton, welcome back. How are you, Mike?
I'm great, Dale. Thank you for having me.
Great to have you back, Mike. And this is the news the market's been waiting for quite some time. So, what's first on mind for you today? And if you want to share your screen, you know where to do it, right?
Yes. Yeah. So I think first thing on mine has to be the CPI print.
Yeah.
I haven't had the chance to really go over it in detail, but if I heard you guys right earlier, it looks like it came in at 7.7, which is, I think 30 basis in year-over-year terms, and that's about 30 basis points lower than consensus. I think on a high level, there's two ways that you can sort of interpret CPI data. One is as a lagging data point for inflation in the past, and the other is as a policy input for the Fed right now. And generally at Invictus, we spend a little bit more time thinking about number two. Are we surprised to see 7.7%, versus 8.0% consensus? A little bit. I mean, that's definitely like lower on the margins than we expected, lower than the Cleveland Fed nowcast. But we're not totally surprised because we've been saying that a rate of change slowdown in disinflation is likely. And one of the reasons that we've known that is we haven't been able to make any money in inflationary assets in quite some time now. And we know that the markets tend to front run the economic data. So for example, the CRB commodity index has been flat since March of 2022. Brent crude has been flat since February. Mining stocks have been flat since February. So if inflation were going to reaccelerate past its June peak, our expectation is that these inflationary assets would be going up, not down slash sideways. So, rate of change deceleration in inflation makes sense. It's kind of in line with what the market has been telling us to expect.
Okay. I
But
do
as a
recall,
policy,
Mike, the last time we talked, your part of your defensive positioning was long bonds. I've never seen a more persistent bear market. Looks like it's trying to bottom out here. You still think bonds are a play? They're probably more of a play than they were a few months ago.
so we're not so much bullish on long-term bonds right now or on duration risk in general. I'd say if you're looking at bonds, you want to get some exposure to treasuries. We like short-term bonds.
Oh, well, I'm
And
talking about last time, Mike. Yeah. So I know. Am I wrong? I mean, tell me if I'm wrong.
so
Uh,
we
that,
did
go
like
ahead.
we did like taking a chance on long-term bonds
Yeah.
when rates were sort of approaching their 2018 highs. We thought that would be a logical place to add some
Okay.
exposure with very well-defined risk. But we have to cut our losses, and we cut our losses when rates went above that level. That was our risk management level.
Okay.
So we got that call wrong, and we have no, given the way that the Fed has communicated with the market and the way we're interpreting the current jobs data and the current inflation data, we think rates probably continue to move up for a little bit while longer. So we're not getting long any kind of duration risk yet.
Okay.
Although,
Okay.
like I said, I think the yield on short-term treasury instruments, 3 months, 6 months, 1 year,
Right.
even 2 year, very limited duration risk, 4 to 5% yields. We think that's pretty attractive as an alternative to cash.
Notes look like they have turned. What's your forecast on yields now? I know some people that think we could see the 10-year fall to 3% or lower.
Um, I have to say, over sort of the intermediate term, over the next, call it 3 to 6 months,
Yeah.
it's hard to get long on the 10-year bond. I mean, it's not to say it couldn't sort of oscillate around its uptrend for a little while, but generally speaking, there's about an 80% correlation between the Fed funds rate and the U.S. 10-year yield. So as long as the Fed is raising the Fed funds rate, we probably don't want to bet on the long bond, at least not yet, right? And inflation came in below expectations at 7.7%. It's still almost 4 times the target rate for the Fed. Initial claims and other labor market data appears to be at sort of a cyclical strong point. So why would the Fed stop tightening? They don't look at really leading indicators, or at least they don't overweight them analytically. They don't really interpret rate of change data the way that investors do. They've been very clear about what their plan is in terms of policy. They're going to continue to tighten. They're going to continue to raise rates. until they see inflation, very, kind of obvious line of sight into that 2% inflation rate. And we're still not even close to that. I mean, it's great to have a rate of change decline, and that has an impact on inflationary risk exposures like commodities, like we just pointed out. But as a policy input, 7.7% is still way too high. They're not gonna pull a pivot over that, right? And like I said, if that means they're going to continue to raise rates, that's bad for long-term bonds too.
Okay, I wouldn't be short these right now. I wouldn't be short. So looks pretty negative to what we had. I mean, look at how yields handled the hawkish Powell, a strong headline number, and they couldn't take out the 435 level. And now we're back at some support. If we take it out, it looks vulnerable to me. Any view on gold? I know that at times you tactically take positions in gold. A lot of people calling this a very important breakout here above 1680. Do you have a view on that?
So when it comes to gold, we think the thing to really understand is real rates, right? This is like one of the closest long-term correlations in finance and financial markets. And the reason is you can kind of think of gold as non-interest bearing money. So generally speaking, when interest rates are going up, gold tends to struggle. So this is kind of an outgrowth of our view on bonds, like we just said earlier. Our expectation is that rates probably continue to rise as long as we have this situation with inflation in the labor market. And so, I think it's hard to get super excited about gold here. And on top of that, I think when I look at it technically, I would say I would say that support or resistance is around, 1730. So we're right below resistance. I would say gold looks tactically more like a short than a long here.
Okay, I'm actually considering trying that. So let me ask you what you are doing and what you're saying in your newsletter, Mike, as far as, we have to catch up from the last time we talked, which was about 4 months ago. So tactically, investment themes, what are your views going into year end? Is it just, we'll see book squaring and tax selling, and will the Fed only go 50 at the next meeting? So what are you doing?
I think there's a good chance of, I think there is a good chance of 50 at the next meeting, especially given this trend, especially given how aggressive they've been up until now. But 50 is still aggressive, relative to history. Overall, our view is certainly still bearish. We haven't really changed our core view since the last time that we spoke, right? Our expectation
is some defensive. Any positions you had in the market was structured defensively, right?
Right. I think the best expression of a defensive mindset right now is cash and short-term treasuries.
Okay.
Or that's just to say lower net exposure. If you have a mind to sell short, there's plenty of great short selling opportunities out there. One way that we expressed our defensiveness was through that long-term, bond trade around the 2018 highs. That was a play on growth more or less, right? And growth did continue to slow, but there's cross currents, right? Because the Fed was continuing to raise rates. So the core view about growth was correct. The expression of that view was incorrect. It wasn't the right way to express it, but we've expressed it in other ways, right? Short cyclicals, long defensives is another way of expressing that slower growth view. And that's worked out pretty well since, certainly since the new year. So that's really the core view. The core view is slower growth, slower inflation, and all of the different ways to express that in the asset markets. The most obvious of which is just low net exposure.
Okay. And midterms, politically, does that go into your thinking at all? What happened in the midterms?
So I think first of all, at Invictus, we're sort of a mind that the business cycle takes precedence over the political cycle. Okay. And there's certainly going to be a lot of news about politics and what's going on and how it's going to affect the economy and how it's going to affect the markets. And I certainly follow all of that. I have to say it's really more signal than noise in our view. And, you could point to a lot of different examples of that throughout history. So, an obvious one is the energy sector, right? Generally speaking, Democrats are perceived as a little bit more hostile toward energy and Republicans as more friendly. But if you look at various measures of energy investment under President Obama's tenure versus President Trump's, the energy sector expanded quite a bit under President Obama and contracted quite a bit under President Trump. Did that have anything to do with politics? No, it had to do with the shale revolution and innovations in horizontal drilling and eventually the shale bust. Energy and politics go together like peanut butter and jelly, and people always talk about them. But the reality is that, for the last, I don't know, a long while now, or at least through that period between 2008 and call it 2020, the politics was more of a sideshow than anything else. It was the business cycle, it was the fundamentals that were really driving the trends there.
Okay.
In terms of what to look for politics, there's two things that we really focus on. One is fiscal stimulus and one is regulation, right? Obviously, a House that's now Republican and the Senate seems like it's still up in the air. The odds are that creates just more gridlock, right? So the odds of any kind of stimulus go down. So that's a deflationary force. Less fiscal stimulus means, generally speaking, slower growth and slower inflation. It's generally bad for risk assets, and it's another reason to be defensive. I haven't seen anything particularly noteworthy in terms of regulation or in terms of different regulatory outcomes that could be a result of this election cycle, but it's something that I'll certainly be keeping an eye on.
Okay. Say new money came to you right now, and that's right, you're not a money manager, but say for example, what are you telling people to do? Just sit in T-bills right now, mainly?
It's the most boring call of all time, but yeah, probably. Unless you have a mind to go short, then I think, like I said, there are plenty of attractive short opportunities. But yeah.
Do you recommend shorts? In
our weekly trade ideas, yeah, in our weekly trade ideas product, we go through our best.
There's Mike.
Long ideas and short ideas, and give some commentary on how we're thinking about portfolio management and the markets as well. But okay. Yeah, unfortunately, from the long side, nothing interesting to say here.
Okay, so and you're not in the camp that we're getting a turn in the dollar. So this could end up being, in your view, a buying opportunity in the dollar, this dollar weakness we're having today.
Yeah, I have to say that's my bias, is that the dollar continues to go up. I think rates are going to continue to go up. I think global growth is going to continue to slow. Those two things together continue to make the dollar more attractive. I don't see any reason that the dollar sees anything more than a viable dip.
Okay, so that's what we'd be happy. I'll be watching the euro around 102. So Mike, anything you want to leave us with? I'm showing your website. You want to talk about what you do and what you offer now?
Yeah, of course, that'd be great. So at Invictus, we provide a number of different research products. Our sort of flagship product is called the Daily Edge, and that's a 5 to 10 minute video that we send out every morning. It goes over the day's most important economic data and market moves, puts them in the context of the business cycle. It's really meant to be a replacement for the business section of the newspaper. I know certainly when I started in the business, everyone I talk to in the business is obsessed with newspapers, really. And I remember when I first started, my employers told me you should spend the first 30 minutes or an hour of every day reading the newspaper and staying apprised of different financial news. And I always found that to be a tremendous waste of time. Business news is very biased. It's sensational. The journalists don't do a good job of connecting what's happening in the economy with the markets. And so the Daily Edge is an attempt to sort of resolve that on behalf of investors.
You curate it for them, save them time.
Curate it, right, exactly. Focus on what's important, explain why it's important, what the implications are for tradable risk exposures using back tests and charts that are really easy to understand, and really do a lot of the legwork for people that they don't want to have to do themselves, right? I think that digging through government data and putting together graphs and charts is it's really boring for a lot of people and they don't like doing it. And Invictus, we love it, so that's our business.
And you have an educational section here that you're going to teach people to look at the things that you look at and learn how to invest like a hedge fund professional.
Right, exactly. The whole idea being, look, we can go through all the historical data for you. We can run all the back tests, all the correlations, so that you don't have to do it, right? Like understanding market history is incredibly important, but incredibly time consuming. And a lot of people just don't have the time to go through it. And so, we do it for you and we try and communicate it in a way that's very easy to understand, very little finance jargon, and really puts all of the complexity of the economy and all the data that comes out into perspective.
Okay, so Mike Singleton, a watchman who also teaches what he watches. Really appreciate you being here, Mike. Best way for people to follow you on Twitter, they could get a hold of you, or where on the website can they get a hold of you?
Yeah, so invictus-research.com is our website. That's where you can probably learn the most about the business and look at the products and so on. Or you can follow me on Twitter @InvictusMacro, and we occasionally post some charts there and some analysis and stuff like that. So I think that's I'm biased, but I think that's a worthy follow too.
Okay, and if you follow Mike, you're definitely is going to watch your back on risk, so you don't have to jump off any of these buildings that are on the cover. So, Mike, thanks for being transparent, authentic. Everyone's wrong once in a while. The key is, how do you lose? And pros know how to lose, so they have money left to be right with. So appreciate you being here today and filling us in. And sounds like pretty much the same theme that we had. No, no green light on this being over. Would you say we're in about the 5th inning and this is going to go on for another year? This kind of macro.
I think that's a good way to put it. I think, why have risk markets really struggled? There's really 2 reasons that can happen. There's the Fed tightening monetary conditions and raising real rates, and causes multiple contraction in stocks. And then there's the growth cycle, right? And right now, a lot of the damage that we've seen has been from the Fed. Growth is slowing a little bit; it's not helping. But the Fed is really responsible for a lot of the damage that we've seen. In our view, the growth cycle is maybe in the 4th inning of cresting. And when growth really slows quickly, we haven't seen a really big earnings down cycle ex-COVID since the great financial crisis. And if we do see that, and that is our base case at this point, policy and real rates and all of that are probably going to take a backseat. It'll be the earnings cycle that's driving stocks. And according to our leading indicators and forecasts and whatnot, it could get pretty ugly.
Yeah, that would really perplex people. Is say for example that chart that I was showing, that yields really do begin to drop, and it doesn't help the market because yields are dropping because of exactly what you're talking about, a big growth scare, and doesn't support stock prices. I think that would catch people off balance, don't you think?
That's exactly right. And I think long bonds will perform when that starts to happen. So I'm completely open-minded about going long, the 10-year bond or the 30-year bond again. It's just sort of a matter of, tactically, when does the market start to price this in? When does the economic data start to show it? When does the Fed acknowledge it, right? That the economy is slowing and that it's likely to start slowing quickly. So I'm with you on the, in principle, on the long bond trade, but we just don't think it's yet.
Okay. And, I know I was going to let you go. Can you explain to me why junk looks better technically, and that's all I know, than treasuries, and even corporates look better than treasuries?
Well, yeah, I think it's because credit spreads haven't widened all that much. They've widened a little bit, right? And what do credit spreads trade on? They trade on growth expectations. They trade with a very close correlation to the ISM manufacturing PMI with a 1-month lead, right? So growth is slowing. Credit spreads have widened a little bit, but it's not slowing that much. So we haven't seen the big blowout yet.
Okay. All right. Appreciate it. My trading warrior brother, Mike Singleton. Check out Mike, read him. He'll keep you straight in case you get caught up in hopium. So Mike, rooting for you. Have a great quarter, and I'll get in touch with you and keep you in the rotation. Okay, buddy?
Yeah, my pleasure, Dale. Thank you for having me.
All right. Mike Singleton, everybody. Thank you for being with us today. And everyone, you could join the team in 20 minutes on the Morning Edge. Don't just count your consumer pain indexes, count your blessings, and good luck the rest of the day. That's it. We'll wrap it up on TGIF tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.